2025 so far has been the year of the multi-billion-dollar bankruptcy. For all of 2024, there were 7,400 retail closures announced. Just through the end of February, we've had more than 4,000 announced in the United States alone.
Volatility is back in the stock market. And the reasons for this have been showing up in the economic data, if you know where to look. My guest today, Danielle DiMartino Booth of QI Research, has been on this story for months. And today she explains what's happening in the economy and what comes next. I'm Ed D'Agostino. Welcome to Global Macro Update. Danielle, it's always a pleasure to see you. You wrote a piece for your clients at QI Research way back in February. It was one of the best pieces I've read all year. And you essentially talked about how the narrative around inflation is disconnected from reality. Can you sort of set the stage for us on your thinking, and then we'll dive into some details?
At the basis of any great narrative, I think, is fear. And the funny thing about the FOMC meeting that was at the very tail end, the 31st of July, is that on that same day, Ed, there was the release, and I don't think the Federal Reserve does anything by coincidence, especially not when it's a 5-year release schedule. But there was the release of the 2019 FOMC transcripts the day the Fed met on January the 31st. Again, no coincidences. And what it walked through was the experience that policymakers that they had in the year 2019. A lot of people have a hard time grasping that when the initial Trump tweet was sent out, this is April of 2018, basically announcing to the world, we're going to launch a trade war. We're going to launch a tariff war. We're going after China. And in those words, right, this was a tweet. This was not, he wasn't, I mean, there's nothing shy about the president. But from that time, April 2018, until the end of April 2019, the CPI, the Consumer Price Index, actually fell. And you know, there'll be some charts in what your clients are going to be able to see that are very simple demonstrations of this. And instead, what the 2019 FOMC transcripts revealed to us is that policymakers grappled much more with the slowdown in growth. We are a world that revolves around trade. You know, at the time, 24% of every U.S. automobile, 24% of the pieces, the components, the parts came directly from China. So slowing down global trade in the year 2019 ended up costing jobs in the United States, and the slowdown in growth, the slowdown in trade, global trade, as my mentor, Lacey Hunt, has told me for years. Any year global trade contracts, the U.S. economy cannot and has not avoided recession. And that was exactly where the U.S. economy was headed in November, December, the fall of 2019. We were heading towards a recession predicated on the slowdown in global trade. And $15 trillion of stimulus spending later, we've miraculously somehow avoided recession. Yay, wonderful. But fast forward to where we are today. The narrative, the inflationistas, the soft landing camp, the individuals who maintain that it's going to be sticky inflation as far as the eye can see. That's not what the data are saying. It's not what the data are saying at all. Chair Powell has shifted his focus to something called market-based core PCE. And I think that that's his and his chief lieutenant, Christopher Waller, Governor Waller. I think that that's their recognition of the fact that if you look at market-based prices, they've come down pretty darn fast. And if you take one additional step and substitute into this market-based core PCE, a metric that the Cleveland Fed came up with called the New Tenant Rent Index. And they've spoken about this. They've spoken about new rents are market rent prices. New rents should represent shelter. So if you substitute out of market-based core PCE, the very broken metric we know to be owner's equivalent rent, it's an imputation. It's a theory. It's a model, but it doesn't represent what we're seeing on the ground. But if you substitute that in, year over year, we're south of 1%. We're below the Fed's 2% inflation target and significantly below that. So in data that we've seen subsequent to this, we've just learned from the census that in the fourth quarter, only 47% of record numbers of new apartments that were coming out of the construction pipelines, only 47% within 3 months of coming onto market were rented. That left 53% not rented. It really is a matter of supply and demand, and that is what is bringing the largest input to inflation down at a fairly rapid pace now that the downside momentum is in train. And yet, if you question the average American, they're going to tell you that tariffs make inflation rise.
And then if you look at the news, right, you hear about eggs, right? Like, but nobody's reporting, at least I haven't seen it, that, what was gas the last time you pulled up at the pump? It's in Connecticut. It's in Connecticut, of all places. It's below $3 a gallon at some places.
I'm filling up for $2 a gallon because I'm a crazy, I used to actually clip paper coupons. Now I use my local grocery store, for every X number of dollars you spend with them, you get an extra 10 cents off per gallon. And so, I'm getting 90 cents off of what is listed in Texas, which is lower than Connecticut. But I'm filling up sometimes for $2, for just under $2 a gallon, and I am not alone. And yet there is this palpable fear that inflation is going to come roaring back. Why is that? Why is that? So that's what I explored when you consider the fact that in a post-Dodd-Frank world, a lot of fast money hedge funds control the narrative. They control where treasuries are traded. They take massive positions. And you know what? If you're short treasuries, you want for those prices to fall. You want for those yields to rise. And that's exactly what we saw in 2024, is that we saw yields rise based on a construct called the risk premium, even though inflation expectations were not going up, because the most visible price, which you just pointed out at the gas pump, was coming down. Individuals know that if they can play hardball with their landlord and threaten to move, and if they do so, they're going to get either a cut to their rent, or they're going to go through with their threat and move and get a lower rent. So on the ground, we've seen inflation come down, but so many Americans continue to live with the latent shock of the price rises that occurred post 2019. And those are not to be dismissed. I'm not trying to imply that, but at the rate we're seeing prices right now, Jay Powell's got a disinflationary problem on his hand. That's a lot harder for central banks to address.
Last time we spoke, you were pretty focused on the labor market, which also is, that factors into this. I mean, how much people make and how much they can expect for an increase and how much they can negotiate. Just like with their landlord negotiating their rent, you sit once a year and negotiate your pay adjustment. What are you seeing there?
When we were kind of at peak quiet quitting, when we were at maxed out working from home, before return to office became its own RTO acronym, the price increases, the wage inflation for individuals who were job switchers, according to the Atlanta Fed's wage tracker, and they track this every month, they were making north of 8% to jump ship. The grass really was greener. And job stayers, so to speak, their wage gains were closer to 5%. So you had this 3 percentage point differential at the peak. This is 2022. 2022 also happens to be when full-time employment in the United States peaked, We haven't seen a higher number of full-time employed Americans since 2022. And that is when job switcher wage inflation peaked. Have a look at what the Atlanta Fed is showing right now. You're seeing both job switchers and job stayers commanding about 4.5% wage increases. So you've seen a complete reversal in terms of wage gains all the way back to where we were headed into the pandemic. And it's a reflection of the things that are not a figment of our imagination. It's a reflection of true job losses and layoffs.
Do you think that continues? Because you were early on this. You were pointing out the anecdotes, 9 months ago.
And 9 months ago, we had a lot fewer Americans working as Uber drivers, working as Lyft drivers, choosing logically, why am I taking $295 a week in unemployment benefits? Why would I even bother applying for initial jobless claims if I can make $750 a week driving for Uber? So they made this logical, rational decision. And I've got a graph that's going to be included in what all of your readers see that show now we're seeing Uber driver pay fall. And if it's not falling for Lyft drivers or for Amazon drivers, they're working a lot more hours to get that same weekly pay. If you look at the latest non-farm payrolls jobs data, you've seen 2 months in a row of a work week of 34.1. Outside from the initial shock of the pandemic, you've got to go back to 2009, 2010 before you see such a short work week. And guess what, Jay Powell? It's not average hourly earnings. It's average weekly earnings that we take home in our paychecks. And for the first 2 months of 2025, that pay has been falling outright, given how short the work week is.
So incomes are falling. Inflation is falling.
The rate of inflation is falling. So prices are not falling outright, but the rate of inflation is well within the Fed's 2%, below the Fed's 2% target.
You brought up Truflation in that great piece that you wrote last month. And I'm a big fan of Truflation's numbers. And I just want to look back at a couple with you, because back in June 17th of 2022, Truflation said that the real inflation we were experiencing here in this country was 11.59%, which it makes a lot of sense, right? Like the official numbers were lower. People were saying that's just not what I'm experiencing.
Mm-hmm. That's right.
Well, now it's below 1.4%.
That's right. And that is 30 million real-time price points that are being tracked on a day-to-day basis. Where are we seeing job losses right now? Where are we seeing prices fall right now? Where are we seeing delinquencies rise right now? Well, according to TREP, even though the worst of the worst appears to be coming off for the office sector, for example, of course, we've got a lot of people returning to the office. But what we're seeing right now is lodging. We're seeing hotel rates come down. We're seeing anecdotes of people saying, I went to Vegas, it was a ghost town. We're seeing people in leisure and hospitality lose their jobs. They were one of the biggest job losers in the month of February, surpassed only by federal workers who had lost their job. And this was a timestamp of February the 15th. So that's when the survey week for non-farm payrolls cut off. So we haven't even seen the bulk of the layoffs that have followed since then. But we're seeing something that I think really started to get market veterans' attention a few weeks ago when we got that personal income and spending report. Everybody looked immediately, oh, let's see what core PCE is doing. Let's see what PCE is doing. And they went, wait a minute. On an inflation-adjusted basis, spending fell 0.5%, declined, and service spending is flat as a pancake? Wait. We've been working on the inflation narrative that service spending always goes up. What do you mean it flatlined and good spending cratered? That's what we're seeing. And that's why we're seeing once the caboose starts to finally come into the station, and that is services spending, which is flatlined, the wheels officially start to come off. And what have we seen in the media, outside of the media salivating that they can finally declare a recession and blame it on Trump? Look, the people believe what they read, they do. But the disinflationary forces, the private sector job cuts, we had Macro Edge they've been doing a great job of tracking layoffs as they're announced. And I've been a bit of a critic of Challenger Gray and Christmas because in 2023 and throughout 2024, as best I could tell, they were understating announced layoffs. How do you have some major retailer in the United States announce that it's closing all of its locations and only managed to tally like 4,000 retail job losses in a month? I'm like, it's your job, Challenger Gray and Christmas, to track layoff announcements, and you didn't even begin to capture half of the jobs that were lost in retail in 1 month. Lo and behold, now that we have the first clean month of Trump in office, Challenger Gray and Christmas pops up with 172,000 jobs lost in February. The sky is falling. They were playing catch up. They were playing catch up to layoff announcements that they know had already occurred. But what's more important here is that despite the fact that there were 62,000 layoffs that they attached to federal workers, well more than that were private sector. And here's the biggest problem. Here is the reason that President Trump and Treasury Secretary Scott Bessent, they've started to mention, that the economy may pause. I think over the weekend, Trump said that we may be in a time of transition people are using all kinds of lovely synonyms for recession, but not actually using the R word itself. Why is that? And that's because economists recognize a phenomenon known as the adverse feedback loop. So the private sector has been in layoff mode for some time, has been in cost-cutting mode for some time. In fact, first quarter CEO optimism rose. And that was one of the few actual aspects that was like, here's a positive headline. Why did CEO optimism rise? Well, because they announced that they were going to be imposing more hiring freezes and firing more people, which is shareholder friendly. You please shareholders, you cut costs, you get a pop in your stock price. But why they're optimistic, that's not necessarily a good thing. And the reason I bring up the idea of an adverse feedback loop is the more job losses we have in the public sector going forward. And by the way, not just direct federal employees. When you read a headline that says, that certain large consulting firms derive 98% of their revenues from federal government contracts, there will be trickle-down effects. There will be ripples into the private sector based on the work that they depend on coming from the federal government. So if the private sector is saying, well, wait a minute, we're going to have aggregate income continue to fall, then going into the year, maybe I thought I was going to be able to tamp the brakes and stop with the cost cutting. But if the aggregate income between public sector and private sector layoffs are going to continue to drag on income in an economy that is 70% spending, well, I got to cut more. I've got to reduce headcount even more to account for less money that people can spend on my good or on my service. So one sector feeds off of the other. And that's why you saw that the unemployment rate was 0.00111 shy of rounding up to 4.2% in February. We came really close to rounding up to 4.2%. From that 4.0%, which did not, the 4.0% in January was a very real thing. And it wasn't even close to rounding up to 4.1%. But now you can see going forward, they're going to adjust the birth death adjustment beginning with March payrolls. That's going to look a lot more like the last few years of the United States, not some crazy imputated level of business births that didn't occur and had to be revised away subsequent to. In March, we get a little bit of reality in the statisticians' imputations, which is going to hurt because that's going to come right on top of the rest of the job losses that we know have been announced occurred, all of these massive multi-billion-dollar bankruptcies that we're seeing in 2025. 2025 so far has been the year of the multi-billion-dollar bankruptcy. Mattel, a huge Canadian telecom company, they had to file 10 different times in the state of Texas just for their subsidiaries here. But multi-billion-dollar bankruptcies are commonplace. And on top of that, I'll throw this figure out there. For all of 2024 in the United States, Ed, there were 7,400 retail closures announced, stores that closed. Just through the end of February, we've had more than 4,000 announced in the United States alone. So the momentum has continued to build, and that's something that someone as rational as Scott Bessent can see and prepare for. And you know what? I'd rather move away from being gaslit to being told the truth. So if the people in Washington are going to be sober and honest with the American people and say, look, there might be some short-term pain that involves, getting rid of the fiscal lunacy, I think the American people would rather be told the truth than read headlines that don't match at all what they're experiencing on the ground.
I hope so. And I've had this conversation with other people that sort of the time to do this, the time to get fiscal sanity back is really right now from the perspective of the president, or not just this president, any president. You have to move quick. You have to move within the first year before midterms, before the narratives start to get spun. And this doesn't matter which party you're from. The time to take bold action is now.
It is. And Ronald Reagan did just that.
Exactly.
He did. There was a massive buildup in the federal workforce during the Carter administration that he felt was just too much. And he came in and cut. Now, defense spending rose. We're talking about making ships at home. We're hearing some things that we'd like to hear. And we don't look back to, we forget. I should forget. I was in middle school, but we forget that the 1980 recession lasted all of 6 months. It was ugly. It was dirty. It was manufacturing based. It was blue collar. People going into that election were angry as all get out. But it only lasted 6 months. The economy was coming out of it by July of 1980, and boom, Reagan got to office. And before the Great Recession of 07 to 09, the double dip recession that started in 1981 was the worst recession since the Great Depression. They called it back then the Great Recession. But we don't think about Ronald Reagan in those terms, even though he was in the White House during a terrible period for U.S. GDP. But we came out of it, to your point.
I think a lot of this is really hard for people to understand. The person that's not the analyst or the economist like you, we've been dealing with supply issues ever since COVID, right? And so then we hear about there's going to be tariffs added. Automobile manufacturers are going to have to start paying 25% more for things that they import. And the narrative, to your point, is that new cars are going to go from, on average, costing $50,000, which already is a ton of money, to $62,000. And what people are missing, and so that sounds inflationary. And what people aren't being told is it's a demand issue, right? It's the demand side of the equation. Am I getting that right?
You're getting it so right. And hats off to Mary Barra. Maybe she should try Hollywood after she's finished with Detroit, because according to Car Gurus in March, there was an 84-day supply of cars, new cars. It's a lot of cars. And there are a lot of cars because people cannot afford the cars. Fitch Ratings came out just a few days ago and said that new car recovery rates are 32%. They're not getting a lot of money when a car is taken by repossession or is traded in. A 32% recovery rate is nothing. And on top of that, you've got auto delinquencies at the highest level since the early 1990s. Forget '08, '09, '10, forget those years. Auto delinquencies with a 4.1, almost rounded up to 4.2% unemployment rate are at the highest on record. Imagine what they're going to be when we see a jump to 4.5% and 4.6 and 4.7% in the unemployment rate in short order here. What those delinquencies are going to look like, because Americans are actually having to pay their obligations. They're having to pay their student loans. And there's a lot of rude awakening that's going on right now with U.S. households who were operating under the assumption that they would never have to repay their student loans, that they would forever be on ice. And so you're seeing people with some of the highest FICO scores see some of the biggest declines in their FICO scores because they didn't qualify for student loan forgiveness. They simply made too much money. And now they're being reported to the Experians and the TransUnions of the world, and their payments are large. They're like, why not be a dentist? I'll never have to pay the student loan back. I'll just take out hundreds of $1,000s of student debt and never worry about it. Well, now they're having to worry about it. Their credit's getting destroyed, and at the same time, they bought a house that they never realized what the cost would be, if their furnace went out, and what the cost to maintain a home was going to be when you were buying it at the very peak of the post-pandemic exodus to the exurbs. So there's a lot of rude awakening right now, a lot of rude awakening for U.S. households. And the last thing that they want to be told when they're irritated is that they're imagining things.
This all has me pretty concerned, right? I mean, I've gone from sort of being in the soft landing camp a few months ago to starting to really pay attention to what you were saying, first about jobs and then going deeper. And then this article came out a few weeks ago from the Wall Street Journal saying that I think it was 48% of U.S. GDP is attributed to the top 10% of wage earners. You factor that in. I mean, what is your prediction? Where are we going with this economy?
So it's 49%, 49.7% according to Moody's. And that was a real eye-opening Wall Street Journal article. The next decile, if you will, they're the ones I'm describing getting hit by big student loan payments. They spend money too. And this is what I have to say about the top 10% who account for 49.7% of U.S. spending. They're fine as long as the stock market never goes down.
Got it.
It's how it works. It's called the wealth effect. It works both ways. And by the way, demographics is destiny. And when 40% of the stock market is owned by individuals who are 70 years of age or older, when 25% of U.S. residential real estate is owned by individuals who are 70 years old or older, that puts Jay Powell in a very tight spot because he can need to lower interest rates. He can want to lower interest rates. He can press forward with lowering interest rates. My guess, they're not going to lower interest rates at the March 19th meeting, and it's going to be a replay of July of 2024. By the time we see March and April payrolls before they meet in mid-May, there's going to be regret. It's going to be the why didn't we cut rates in July of 2024? Here we come in September of 2024 with a 50 basis point jumbo rate cut. I think we're going to see a replay of that script because once we see March and April payrolls, it's going to be pretty apparent that the Fed made a mistake by not lowering interest rates at the March 19th meeting. ... However, the Fed is trapped. 70-year-olds and older own 40% of the U.S. stock market. They're kind of okay. Look, fine. A year ago, I was making 5.5% on my cash. Now I'm making 4.25%. I'm okay with that. But don't touch it. If I'm making much less than 4% on my cash, that doesn't work. I'm retired. In 2001, I'm 70 today. I am the median age of a U.S. baby boomer. I am 70 today. My mom is 78. She's at the very outer edge of baby boomer. She's the oldest baby boomer, but I'm pretending right now I'd look really good if I was 70. I'm pretending right now that I'm 70 years of age. And here comes Jay Powell, and he's cutting into my interest expense. Now, I, as a 70-year-old, spend 70 cents of every dollar of interest income I make. It's money. It's cash income, and I'm happy to spend it. If my NASDAQ position portfolio goes up by $1, I'm only spending 2 pennies of that. I don't liquidate, I don't monetize near as much of my paper wealth as I spend of my interest income. But Jerome Hayden Powell up in the Eccles building needs to stop lowering my interest income now, immediately. How's that going to work when we're in recession? A recognized recession. Because in 2001, me, the theoretical 70-year-old, you know what? I was 20 years younger. So what? I went to go work at Southwest Airlines. I went to go work at Walmart as a greeter. I went back and got my old job. In 2007, there went my retirement savings again. But you know what? 60 was the new 50. Young, sprightly, fine, great, wonderful, do not have to sell my stocks. I'll go back to work again. So I don't have to sell my stock. Today, what's that 70-year-old going to do if Jay Powell lowers the amount of income that they're collecting in interest when they own 40% of the stock market? This is the catch-22 that has got Jay Powell in a terrible trap with inflation coming down as quickly as it is. He won't have any choice but to lower interest rates in 2025. But the risk is the 70-year-olds and older start to liquidate their stock holdings. I don't even know what that looks like, Ed. I couldn't pretend to tell you, but I will tell you that that will test something that John Bogle is spinning in his grave, concerned about being tested. That's passive. And that will test passive. And John Bogle, before he died, did an interview and said, God help us if passive is ever more than 50% of inflows to the market. It is, but it's never been tested.
You ended your research note with one of the best lines in research that I think I've ever read. You wrote, trade the narrative, but own the truth. So you just spoke a whole lot of truth. I think people are going to be really interested to learn more about your work and where they can find you, Danielle. Where should they go?
Come to dmartinobooth.substack.com. And if you run money, if you run your family's money, if you run a small family office, we're also going to be offering an institutional entree, if you will, just for you. And I've never done this before, at qiresearch.com. So if that's something that you feel that you have the appetite to take on, our institutional investors absolutely love the research. They love my flagship weekly. You're going to get a sample of that. You have access to my Bloomberg chat room, which is always on fire, with all kinds of colorful commentary, as well as my private Twitter feed. But regardless, read the research, because I have no bias. I have no reason to have a bias. I have no narrative. I just give you the data, and you make your decisions based on that. But at least you're owning the truth, not trading the narrative.
Danielle DiMartino Booth, thank you so much for your time. Great to see you.
Thank you for having me today.